This is a massive week for economic data out of the US, namely because we've got the jobs report coming on Friday. Certainly there's a whole raft of jobs data coming out over the course of the week, but Friday's payrolls number is really going to be the big ticket item because we saw massive revisions at the last time around. We also saw a miss in terms of the headline number. So within this video, I'm going to take you through a number of different charts, showing you exactly what happened last time, showing you some of the underlying metrics that highlight the direction of travel for the US jobs market, and highlighting how this report provides the basis for significant volatility in price action when it comes to the likes of the US dollar, the likes of the NASDAQ, with tech stocks really coming under pressure recently, and crucially for the price of gold, which has just hit record highs. So as we can see here, first and foremost, this is the outlook in terms of what markets are expecting from this report. By and large, there's an expectation that we see the headline numbers remain very steady. 73k last time around, 75k expected this time around. That number notably is higher than when I checked it at the back end of last week. So there's some improvements to the outlook according to the latest forecast, but nonetheless, the figures still very low. Anything below 100k, certainly historically, has always been treated as a pretty poor number. This comes off the back of 3 consecutive months of weakness when it comes to those payrolls numbers. So that certainly wouldn't exactly lift everyone into thinking that the jobs market is suddenly fine and dandy. If we look at the other sort of major numbers, you can see flat on unemployment, flat on average hourly earnings, both monthly and annual, and a tick lower in terms of the participation rate. If we look at the U6 unemployment rate also, which is a key one, that is sort of total unemployment. It takes into account people that have left the jobs market essentially. That's also flat. And this is notable, right? Because we have, of course, been seeing significant weakness from the payrolls number, not necessarily seeing that same kind of trajectory or sharp move for the likes of the unemployment rate. And that is notable. And so as we move through it, we can look at exactly what could happen in terms of these payroll numbers and what we think the sort of implications would be. In terms of the payrolls, the thing that really sort of grabbed the headlines last time around was the fact that we saw this massive revision to the prior two figures, 258,000 jobs revised down. And you can see that in terms of the two sort of columns or bars at the bottom right-hand side of this chart. So you can see historically they are very large, even taken on their own. And certainly going back to back, this is a massive revision to a period of time that, by and large, we have been seeing downward revision time after time, right? You can see the last 6 payrolls figures have been revised lower. And so let's say we see a 75k number this time around. What's to say we're not going to see a downward revision? Soon enough, that turns into 50k. And bear in mind, we're also seeing the potential for a downward revision to the prior figure as well. So if we see revisions to last month's number, well, the past 6 months would make me think that we were going to see a downward revision. So in the past, some of these revisions have by and large been sort of overlooked in favor of the more relevant and near-term data, which is what markets generally do. It's just the sheer size of the revision last month that really grabbed the headlines. But it does put us in a position where markets are going to likely pay closer attention to the prior month's revisions if we see any downward revisions in particular. So this time around, like we said, 75k. The previous revisions have been seeing very significant downward revisions, and they've been growing. So what's to say that the 73k from last time around doesn't suddenly turn into 0, right? That is a distinct possibility. So keep a close eye out for the revision to the previous figure. Now, we've seen updates in terms of the breakdown for the payroll, so I thought it's interesting for us to look at exactly what sectors are outperforming or underperforming, which are lagging and dragging, and which ones are pushing the economic sort of hiring side of things higher. Well, notably, the strength really comes from that grey section, which is education and health services. So the services side of things. Now, I'm recording this after the ISM manufacturing PMI number, where we did see a little bit of an improvement in terms of the employment side of things, but still in contraction territory. But you can see here in terms of the numbers that we've seen as a major drag. Initially, a couple months ago, we saw this major drag from the government side of things that could be associated with Doge. Then you're getting these sort of green ones, which are trade, transportation, and utility. So trade, you can see the tariff side of things coming into play. And then manufacturing, again, likely to be impacted by the actions of Donald Trump and his team when it comes to tariffs. Manufacturing sector in particular really would have felt the pinch of higher prices for imports, but also a lot of uncertainty around the trade of goods going forward. In terms of the government side of things, I find this really interesting, right? So generally seeing government hires as a percentage of overall hires on the rise generally happens at times of crisis, right? And you can see that here, right, with the grey sections, the sort of vertical grey bands. In 2008, we suddenly saw a major uptick as essentially private companies stopped hiring to the same degree. The government steps in, up spending, up stimulus, ups hiring, and as such, government jobs take up a greater proportion of overall hires. The same kind of thing you can see here back in the pandemic times. But under Biden, we actually saw that same kind of thing, which is quite rare. We don't normally see that. Normally, you see sort of the private sector really taking over when the economy is doing relatively well. Well, under Biden, we did see that percentage on the rise, and it helps lift economic numbers, right? When we're looking at payrolls figures, if you're getting that strong sort of underlying boost from the government spending, from government investment and hiring, it makes things look better. But as you can see here, it's starting to roll over a little bit. So that provides potential downward pressure on the overall payroll numbers just under Donald Trump as a whole. Bear in mind also his policy when it comes to immigration also means that we're likely to see people leaving the country, and therefore you're looking at a situation where there's less people looking for jobs. So hiring numbers by and large would not necessarily look the same. If you suddenly had a huge influx in terms of migrants, you're looking at more companies potentially hiring, more jobs being filled because of that, more demand in the economy because of that. So in actual fact, immigration by itself is actually a significant boost to the economy and certainly boosts the numbers when it comes to hiring. If you look at the ADP number, this is a really interesting one because everyone's been slating the ADP, and certainly myself in the past have always said, there's question marks around just how useful that is when it comes to the Friday reports, the sort of main NFP number. This looks maybe a little bit messy, but let me sort of take you through it. So essentially we've got the two lines at the top are the payrolls numbers. The first number that comes out and then the ultimate number, right? So the ultimate number that is resolved out to once the revision comes in is in the sort of more orangey line, and then the red line is the initial number as it comes out. And we've been talking about these downward revisions, right? So that's why over the course of the past 6 months, we've seen this wide gap between the initial number and then the downwardly revised final number, right? And what's notable here is if you look at the orange line, which is the final number, sort of once it's revised, and the green bars, which is the ADP number. In actual fact, the ADP number is quite useful for predicting the direction of travel and the sort of figure we could expect for the payrolls figure. But in actual fact, it's more useful for telling us where it ultimately is. So if you're seeing a major sort of divergence in terms of the initial payrolls number and the ADP number, there's a good chance that that payrolls number, the headline number, gets revised in the direction of that ADP. We haven't, at the time of recording this, seen the ADP number. So, it's worth watching that. Bearing in mind, of course, there's a caveat to it, but essentially it's worthwhile bearing in mind, even if markets don't react too much to it, because they might disregard it and think, well, all we care about is Friday's numbers. That might be the case. It makes sense, though, to bear that in mind as a potential precursor of where we go in the future. Because, yes, it might not necessarily be that accurate for the time being, but it might be accurate for the revision down the line. And with that in mind, we can look here at exactly where last month's number is relative to the ADP. And in actual fact, as we see at the bottom, I've got the sort of differentials between them. The dark blue is the differential between the final number and the ADP, and you can see that the final numbers are very close over the past 6 months. We've seen them very close. Whereas you see wide swings, so those light blue columns really highlight that the initial number is often wider the mark when it comes to the ADP. So if you look at the initial compared to the ADP from last time around, it's not necessarily that different. That makes me think we're not going to see a huge revision to the prior figure. May not necessarily be the case, but certainly when it's come to the final one, that's generally been a lot closer to the ADP number. And the fact that we've already got the ADP very close to last month's initial, that to me points towards a higher likeliness that we don't see a huge revision this time around when it comes to last month. I thought this interesting. This is the Conference Board survey, and they survey people asking them exactly how they see the jobs market at the moment. Are they finding jobs plentiful? Are they finding it easy to find jobs? Or are they finding them hard to find? So this is sort of a sentiment signal. But what's notable here is we've been seeing the view of jobs being plentiful really sort of driving downwards over recent years, getting into the kind of levels that we saw back in 2021 within that recovery phase. And at the same time, you can see that sort of bottoming out in terms of those seeing things as hard to find or jobs as hard to find. So really it does point towards a worsening of conditions within the jobs market at the moment. But bear in mind, as you get closer to full employment, then that would be the case generally. We also have the JOLTS job openings. Once again, I'm recording this on Tuesday, so we don't have that out quite yet. But the direction of travel by and large is fairly well defined, in particular when it comes to the job openings, which has been on the decline. And it's worthwhile also looking out for quits. Bear in mind that quits, by the sounds of it, isn't that great, right? If you quit a job, it's not good news. But at the same time, if you're emboldened to quit rather than being laid off or discharged, then that says something. That says that you feel like you've probably got another job waiting in the wings. So higher quits versus layoffs mean a stronger environment, a stronger jobs market. And in actual fact, we have seen some improvement, but that sort of stabilized a little bit. Job openings also has been moving more sideways of late. Notably, you can see here, I've inversed it just to sort of pair it up on the left-hand side, but you can see unemployment hasn't necessarily followed this trend. So by and large, unemployment has been largely flat. It's at 4.2%. It's not necessarily something to worry about at the moment. Certainly, given the fact that the big focus at the moment has been on payrolls, if we were to see unemployment suddenly spike, then certainly that would grab the headlines in a meaningful manner. But at the moment, it's not really looked that way, and we've been seeing it by and large trading sideways or treading water. Then, of course, the third part of it is the wage growth side of things. And we can see here that by and large, there is a decent relationship between average hourly earnings and inflation. On this occasion, I've got it marked down as core CPI inflation. And then at the bottom section, I've got the sort of 3-month annualized, because you're going to see variation on a month-on-month basis. I don't necessarily want a year-on-year because there's going to be too much data in there. It doesn't tell me about what's happening right now. And so by utilizing the 3-month annualized wage growth figure and then looking back to where we were pre-pandemic, it gives me an idea of what is the norm for the Federal Reserve to be comfortable with. And whilst we have sort of seen a bit of a tick higher, a little bit of a move outside of that grey band at the bottom, I do think that wage growth around these levels isn't necessarily too much of a problem. Markets are expecting it to remain steady this time around. So unless we do see a major surge in terms of the wage growth figure, don't necessarily think that's going to be the main mover on this occasion. Now, in terms of market expectations for rate cuts or pauses, we have seen quite a lot of stability over the course of the past month, in actual fact, around expectations. Now, the sort of outside view of additional rate cuts for a move down to 350 to 375, that is the second most likely event. In actual fact, the expectation here is that we see a rate cut in September, but then one more beyond that to a rate of 375 to 400, or a band of that. So 2 rate cuts currently the base case scenario. We could see a third, and certainly there's almost 40% chance that we're seeing priced in for a third rate cut. So Certainly, if we're looking at this report, the question mark is, does it embolden those views that the Fed has to act right away and keep acting, keep cutting interest rates in the face of weakness from the jobs market? We've been seeing significant downward revisions in terms of previous months. We're expecting further weakness, 75K. We could see a downward revision to last time around, but like I said, I don't necessarily think it's going to be as big a revision as we've seen over the past couple of months. So certainly there is the basis for us to see signals, further signals of weakness. Markets are expecting a worsening in terms of the job openings, a worsening in terms of the ADP. So we're going to be seeing the JOLTS numbers coming out, the ADP numbers coming out, the jobless claims coming out, and then the jobs report. And by and large, markets expect pretty much all of them to worsen. So as a picture, as a whole, it does provide the potential basis for a move towards the left-hand side of this image, which is towards additional rate cuts, i.e. 3 rate cuts for the remaining 3 meetings this year. But of course, it depends on how the data comes out, right? It might not necessarily come out weaker. Maybe we see a beat and it pushes back in the opposite direction. That's where you should be keeping a close eye out for this event in itself. So let's just jump onto the charts and see exactly how things are shaping up. First and foremost, this is euro dollar. So I have overlaid the 2-year yield. Now, we're talking a lot about yields at the moment, actually. The 30-year certainly on the rise, notably within the UK. But here we're talking about the 2-year, and the 2-year is a good proxy for market expectations for rates over the near term. So if you want to see where markets expect interest rates to be moving, you know, how data is impacting expectations around the Fed, utilizing the 2-year yield is a good way of doing it. And the 4-hour chart at the moment shows you, and bearing in mind I've inverted this, so let me just uninvert it. This is it in its normal format. So we've got euro dollar here, and then we've got the 2-year yield. In actual fact, I'm going to kick off by just showing you it with dollar index. And as you can see here, there we go. So this is the relationship over the course of August. And that is that a lower yield would mean the expectation of a lower dollar. So a weaker dollar with additional rate cuts, right? It stands to reason. So let's flip it back. We'll go back to euro dollar and know that if we see data that essentially means we're going to, here we go. If we see data that points in the direction of additional rate cuts from the Federal Reserve, it means potential weakness for the US dollar. So in terms of price action itself, we have been seeing very strong strength for euro dollar over the course of this year thus far. Now, we, of course, have been regaining ground at the moment following the weakness seen here over the course of July. But we haven't necessarily broken up through your major swing high, which is up here, 1178 recurring. So do we break through that level? Certainly we've been sort of stuttering a little bit just below that. This is the sort of area that we're 173 up to 170. Yeah, it's essentially 173. So you've got 173, 174, that kind of zone of resistance at the moment. If we were to break back down your support level here, certainly if we're coming out with strong economic data, it's pushing back against the idea that we're seeing rate cuts coming into the 4 over the near term. Maybe it pushes back over the expectations of 3 and just reiterates that we're going to see 2 rate cuts, things like that. Then that could point towards a potential near-term weakening of euro dollar as we see the US dollar strengthening. In particular, a breakthrough 11574 would point towards that sort of topping pattern happening over the near term, and we start to roll over for another pullback. However, we still have got price action sort of remaining within what essentially looks like near enough a range at the moment. We're starting to see a little bit of strengthening. So we've pulled back. We're sort of trying to break up through this 1173, 1174 kind of resistance level. Certainly if we do break through that, then you'll be looking at 1178 as your next port of call. But the expectation at the moment is for a weakening when it comes to the data. Quite whether that happens or not remains to be seen. But certainly if it points in the direction of markets needing to be expectant of additional rate cuts or a faster pace of easing, that should cause the likes of euro dollar to rise. Now let's look at gold. Now gold has been a great chart to be watching out for over the course of recent years essentially. Now That's your trend. So you've very clearly got a bullish trend in play, but notably we've been seeing this breakout. I haven't got it drawn on this one. So we've got this sort of symmetrical triangle breakout that's just taken hold, right? I mean, different ways to draw it, but essentially, let's see, is it down here? There we go. So there's your symmetrical triangle breakout. Your breakthrough trendline support was confirmed with a rally through 3409. Then we've just been taken out the next swing highs one after another, and now we're hitting record highs, right? So there you go, monthly time frame, record highs for gold. Now there's a number of reasons for this. One key area is the debt situation, but nonetheless it certainly also reflects sentiment around actions of the Federal Reserve. And if we're expecting a period of significant easing from the Fed, I would expect gold to continue to rise. Now, near term, you're looking at that swing low having just been put in at 34.70. As long as we remain above that level, the bullish trend clearly remains in play. In particular, if we see weak economic data coming to the fore over the course of this week, then, as we see here, we get that relationship here between the 2-year yield, once again, and the likes of gold, which essentially means if we expect additional rate cuts, if we're expecting the Federal Reserve to play it loose when it comes to monetary policy, then expect to see gold on the rise once again. And closing things out with the NASDAQ, it's certainly been feeling the pressure as we start off a month that is synonymous with underperformance for equity markets. September starting off with a whimper, a bang. Not sure exactly what you want to say about it, but it's certainly not starting off how the bulls would want it. And crucially, coming back down, having dropped down through trendline support, we're now coming back into this key support level 22969. By the time you watch this video, that might have really broken, but essentially you're looking at the potential for a topping pattern here. Now, when we're looking at the relationship between expectations of action from the Fed and the NASDAQ, it's not always clear cut. And we can see that here, right? The beginning of the year, essentially before Trump comes into power, you can see a positive correlation between the two. So what this means is essentially when we're seeing expectations of additional rate cuts coming into the fore, we're seeing downside moves in terms of the NASDAQ, right? So that, to a large extent, really reflects the sort of fear around inflation. Now, more recently, we're seeing this sort of divergence. Now, if we were to invert this, let's just invert that, get it on the 4-hour chart, we can see that by and large, we're seeing that inverse correlation taking hold between the likes of the NASDAQ and the 2-year. So if we invert it, it means essentially if we're looking for additional downside to come into play in terms of rates, then you would expect to see some strength coming into the fore. So we've got that inverted move. So if one goes up, the other one goes down and vice versa. But it's interchanging, right? It's not necessarily super reliable at the moment. And that's because sometimes it really comes down to what the reasoning behind it is, right? If we're seeing lower inflation and that's adjusting the expectations for where rates are going to go, then that's good news. But if it's sharp declines in terms of payrolls, if it's economic weakness, and suddenly we're seeing, the expectation of rate cuts, well, when you're looking at equities, that's supposed to be reflecting of the strength of the consumer, the strength of the economy. And so seeing a collapse in terms of the economy isn't necessarily great news, even if it does mean that you get the odd rate cut. So it really comes down to what the data is looking like. And that's why if we see weak economic data, this time around a weak jobs data, let's say we saw a minus 100 payrolls figure, just because that then pushes the third rate cut as being very likely, or a 50 basis point cut as being likely for September, doesn't mean it's good news for equities. It could be, but there's a good chance it could also be bad news for equities because people don't necessarily feel that confident in risk assets when we're seeing a potential economic crisis coming into the fold and question marks about recessions and alike. So I hope that has been useful. Lot to get through, 25 minutes of the video, but this is a massive report, a massive release. It's going to tell us a lot in terms of the direction of travel from the Federal Reserve. And like I said, it's coming off the back of a month that by and large hasn't seen a huge amount of movement in terms of expectations for the Federal Reserve. Perhaps that changes as we kick off September. Equities already down, gold hitting record highs, the US dollar coming back into strength, then starting to weaken once again. So some question marks around there. Interesting times. As I said, thanks for watching. Like, subscribe, follow for more content like this. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading. Thank you.